Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at CORZ Scientific.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
All right, so CORZ Scientific. When most people hear that name, they immediately think digital asset mining, one of the biggest operators in the U.S.
Exactly. But if you're looking at the stock today, you kind of have to throw out that old playbook.
Yeah, the core story here isn't about their hash rate anymore, is it?
Yeah.
It's about this really aggressive strategic pivot we've seen this year.
It really is. We are watching a company just fundamentally redefine itself.
Yeah.
And the market is definitely reacting.
Oh, for sure. I mean, look at the recent performance. It's got a 14.66% return over just the last 7 days.
Right. And if you zoom out a bit to 90 days, you're looking at a solid 17.70% gain. That momentum isn't, just tied to Bitcoin's price.
No, it's built on this huge expectation that they're going to become a key player in the AI infrastructure boom.
So let's unpack that pivot because it's massive. They're moving from basically running these huge warehouses full of computers mining digital assets
To offering what they call high-density collocation, or HDC, services.
And that HDC term is really key here. It's not just renting out server space.
Right. It's about providing super high wattage per rack, stuff that's specifically designed for high-performance computing.
Exactly. The kind of power that's essential for these huge AI workloads, like training large language models. GPU clusters need way more power density.
Way more. And specialized cooling, too. It's a totally different ballgame from Bitcoin mining rigs.
What's really fascinating here and what gives them this, huge advantage is where they started.
You mean their existing facilities?
They already own and operate these huge energy-powered sites all across Texas, Georgia, North Carolina.
Analyst reports really highlight that. It's a unique head start. These miners, they secured massive amounts of power capacity years ago.
Right, and they did it in places where land is cheap and power is reliable. So while they still have to, retool the insides of the facility for AI chips.
They get to skip the biggest hurdle.
Exactly. They skip the years-long process of acquiring land and getting all the utility approvals. They're basically sitting on this ready-to-use, energy-powered real estate.
Okay, so the centerpiece of this whole transformation, the thing that really gives it teeth, is that massive partnership they struck with CoreWeave.
Ah, yes. The CoreWeave deal. That is the cornerstone of the whole strategic vision.
This relationship it completely changes the company's revenue profile.
It really does. We are talking about long-term, 12-year contracts, and the potential revenue could exceed, get this, $10 billion over that time.
Wow. For a company used to the wild volatility of the crypto market, a 10-figure, multi-decade contract is. I mean, it's a game changer for stability.
And the structure of that contract is where the real value is, right? It's not just a handshake deal.
No, it's secured with features designed to de-risk the whole thing.
Absolutely. It's built around what's called a take-or-pay structure.
Which means CoreWeave has to pay for the power they committed to, whether they use every single kilowatt hour or not.
Right. Which makes sense in the AI space.
Yeah.
These companies need to lock down capacity years in advance, so it guarantees revenue for CORZ Scientific and guarantees future space for CoreWeave.
Plus, the pricing is fixed, with annual escalators built right in, so they're targeting long-term growing revenue.
And that visibility lets them go after their expansion goals with confidence. Management said they're aiming for 250 megawatts of billable capacity by the end of 2025.
But that's not even the big number, is it?
Not even close. The real headline is they expect to reach over 1.3 gigawatts by 2027.
1.3 gigawatts. That number alone shows you why the market is treating them less like a miner and more like a future utility for the AI world.
Shifting gears just a bit, we can't really talk about the stock's recent moves without mentioning that whole merger drama.
Ah, right. The shareholder vote. They voted against the proposed merger. To some people, a field merger sounds bad, but the street saw this very differently.
It was a huge statement of conviction from shareholders. They turned down an all-cash offer because they believe the independent company, the pure-play AI infrastructure operator,
It's worth way more in the long run.
Exactly. It removed months of uncertainty. Bullish analysts immediately framed it as this decisive moment, proof that the company is all in on its own growth plan.
Okay, so this is a good transition point. The vision is clear, the contracts are there, but how much is this pivot costing them right now?
Well, the Q3 2025 financial results give us a good look. and it shows a company navigating a very expensive transition.
The results were definitely mixed.
They were. Revenue for Q3 came in at $81.1 million, which actually fell short of what analysts were expecting. Consensus was closer to $107 million.
Missing on revenue is never ideal, especially when you're spending so much. But there were some bright spots.
Right. The bottom line was more encouraging. The net loss shrank dramatically, down to $146.7 million.
Compared to what it was the prior year?
A staggering $455.3 million loss. And the reported EPS loss of negative 46 cents actually beat estimates. So while sales were soft, they managed to surprise on the earnings side.
And when you dig into the different segments, you can see why this pivot was just absolutely necessary.
Oh, yeah. Digital asset self-mining revenue, it dropped to $57.4 million.
And the reason for that was they mined 55% less Bitcoin.
It just highlights the tremendous pressure on the traditional mining business. The cost to mine a single Bitcoin shot up dramatically in Q1 2025. Margins were getting squeezed hard.
So even with the Bitcoin price going up 88%, the lower output and higher costs meant that business was becoming less viable.
That 55% drop in Bitcoin output is all the proof you need that this HDC transition is the only sustainable path forward.
And we are already seeing some good signs from the new business.
In stark contrast to the mining decline, the high-density collocation revenue rose significantly to $15.0 million in Q3.
Okay, so that double-digit number shows the strategy is actually working. Capacity is coming online.
Exactly. Now, a crucial point for a story like this is liquidity. You need cash to build.
And they closed Q3 with $694.8 million in total liquidity, which is cash plus their Bitcoin holdings. So they have some runway.
They do, but you have to view that against their debt. They're still carrying about $1.12 billion in total debt.
So while they can fund the build-out, that debt load is a serious anchor. It puts a lot of pressure on them to execute flawlessly.
Okay, so this is where we have to get into the cautionary side of things, the part of the story where the debate really lies.
Right. We've laid out this enormous upside with the AI pivot, but the market has clearly already priced in a lot of that future success.
A lot is putting it mildly. The company's currently trading at 15.7 times sales.
Let's just pause on that number. 15.7 times sales. What does that actually mean in context?
It's enormous. The U.S. software industry average is around 4.7 times sales. So Core Scientific is trading at more than 3 times the industry average.
So that premium basically means the market is pricing them as if they've already hit those 2027 capacity goals today.
Pretty much. Which leaves, zero margin for error.
That kind of multiple signals some serious risk. If their HDC growth stalls or they hit any delays with CoreWeave, investor optimism could fade really, really fast.
And you can see that skepticism reflected in the short interest figures. As of mid-November, the short interest is sitting at 20.88% of the public float.
Anything over 20% is significant. That means there's a large group of investors betting substantial money that this whole AI pivot story won't meet these sky-high expectations.
It's a big number, but it's worth noting the days-to-cover ratio is relatively moderate at 3.3.
So a lot of people are shorting it, but it wouldn't necessarily trigger a massive short squeeze. It suggests the shorts feel it's a manageable risk.
Right. And despite that short interest, the bullish narrative from analysts is still incredibly strong, especially after the merger was rejected.
Yeah, several analysts have raised their price targets significantly. Some are going as high as $34. That shows a ton of confidence in management's plan.
That confidence really hinges on them successfully converting their power infrastructure and on AI demand staying robust. But let's circle back to the key risks.
We mentioned the $1.12 billion in debt. That's a huge one.
It is, and operationally, they are not consistently profitable yet. They had negative adjusted EBITDA in Q3 and negative cash flow from operations in Q1.
So they're still burning cash to fund this expansion.
For now, yes. The whole investment thesis hinges on them flipping from burning cash to becoming a cash flow machine powered by CoreWeave.
And the final risk, which I think gets overlooked sometimes, is concentration risk.
Good point. They've swapped their reliance on volatile crypto for a reliance on a single major partner in CoreWeave.
Exactly. Even with the take-or-pay contract, the company's future is heavily tied to the financial health and continued expansion of CoreWeave for the next decade. They have to nail that contract and at the same time work to bring in other customers.
So what does this all mean for you, the investor? We have this story of radical transformation shedding the volatility of digital asset mining.
And trying to capture this high-growth, high-margin world of AI infrastructure.
The CoreWeave deal is the definitive proof of the opportunity, and the independent strategy gives shareholders a direct stake in that AI narrative. However, the premium you pay to enter this investment, that 15.7 times sales multiple, is the cost of buying into a future that is still very much being built.
So the core investment decision is whether you believe management can execute a massive infrastructure build-out under the pressure of $1.12 billion in debt, and whether the inevitable bumps along the road are enough to cause the market to reevaluate those elevated expectations before they hit their gigawatt targets.
Thank you for joining our analysis. If you found this useful, please subscribe, like, and comment to support Smart Wealth with Joshua. We will be back tomorrow with another stock catalyst breakdown.